Hello and welcome, everyone. Excited to have you join me. I'm Camilla Jeffs, CEO of Steady Stream Investments. And today we're going to talk about how to vet a multifamily deal as a passive investor. So this is my educational series. It's just a short 20 minutes with 10 minutes Q&A at the end. So if you'd like to post any question in the chat box, feel free to do so and I'll answer them at the end. So how do you even vet a multifamily deal? So if you decide, okay, I think I do want to invest passively, we're going to talk about how to do that. So first, just a little bit about me. Steady Stream Investments, we help you build wealth by investing passively in multifamily syndications, which is just a fancy word for group investments. And our goal is to help you have financial peace of mind and leave a legacy for your family. So today we're going to learn a couple of things. So we're going to start learning about what is a real estate syndication. We're going to learn about what makes a good deal. And then we're going to learn how to review an investment summary. So let's start with what is a real estate syndication. So remember, real estate syndications are simply group investments where people pool their money and resources. So some people have money to invest, other people have time and expertise, and then we all put it together and we purchase a large commercial property like an apartment building. And you can invest your money as a passive investor and get all the benefits of owning real estate without the hassle of being a landlord. That's what I love about passive investing, is that you get an opportunity to invest your money. And when I realized that I could just simply invest my money and not have to put in all the time and work and swing the hammer and call all the tenants, that was a light bulb moment for me, which is why I'm so excited about it and why I love sharing with other people how they can be real estate investors, but not have to do all the landlord stuff, because that's icky. So what even makes a good deal, though? So how do you know if this is a good deal? Well, number one is the team. You need to vet the team. So if you think of a syndication, like kind of like an airplane ride, there's the pilots, there's passengers, there's flight attendants, there's mechanics, and everybody kind of works together to get the plane safely to its destination. Well, passive investor, you are like the passenger. You're the one that gets to pick your destinations, meaning you get to pick which deal you invest in. And then you let the attendants, the pilots, kind of take you there and make sure that the journey is safe and smooth for you. Now, there's always rough air, right? You've ever been on an airplane ride? You've always experienced rough air, and it's no different in the real estate world. We're not here to say it's all roses and happiness. There will be challenges along the way. But the great thing is, it's like on an airplane, if you have a great pilot, they can help navigate that rough air and help you get to where you want to be safe and sound. But it's really important that you pick the right pilot and the right team. And this is where it gets really critical. So some of my favorite tips for investors for picking the right team is to look for those who have a strong track record, those who've been doing this for a long time, who have some good deals behind their belt, so that they can help you they know what a good deal looks like and they know how to navigate it, and they've taken care of investors before. So that's my best tip for finding the right team. The second thing, what makes a good deal is if it aligns with your goals. So if you think about your goals as a passive investor, are you investing for cash flow, right? Do you want to replace your W-2 income? Or are you investing for appreciation? Maybe you don't need to replace your W-2 income. You love your job and you want to stay there and you're doing great. But you do want to build wealth for the future. So perhaps you would be investing for appreciation over cash flow. And so those are the things you need to kind of determine yourself as a passive investor. And then finally, is the market a good fit? Sometimes it's a market where you grew up in, and you know that cool things are happening in that market, jobs are coming, people are coming, and you have some insider info. And so that would make you more likely to invest in the deal. But other times you don't know the market. You don't know what it is that the team is presenting. And so then you can do some research. And what makes a good market? Well, there's three things. There is population growth. You want to see that there's more people moving in than moving out. You want to see job growth. which goes hand in hand with that population growth. So you want to see lots of job growth happening in the area. And then you also want to see job diversification, which means you want to be able to see that that there's a variety of jobs, that not just one industry, like it's not just Amazon that's in the area providing all the jobs for everybody. You want to have lots of good diversity of jobs. So now let's talk about an investment summary. So if you've seen any of the deals that I've been able to share with you, you see that there's a large investment summary, and there's usually 4 key areas of that. So the first area is the executive summary. In the executive summary, it's going to talk about what the returns are. So it's going to give you kind of an overview. It's an overview of the whole investment. This is a really great snapshot of all the information that you need to know. And then the rest of the investment summary just goes into detail about all the different things on here. So the executive summary is going to tell you what the returns are. It's going to tell you the percentages that you'll be earning. It's going to tell you the plan. What's the plan for the property? Are we going to renovate the units, or are the units already renovated and we're just going to maintain it? Or are we going to fix the expenses? Or maybe the occupancy is low, so we're just going to focus on filling up the building. There's a different plan for every single investment. It's going to talk about the loan and then the structure of the whole thing. Then you move into the investment offering, and you're going to have in there's going to be a recap of why it's a good deal and according to the sponsors. And then you, as the passive investor, need to decide for yourself if you believe that that is a good deal and it's one that you want to invest in. Sometimes they'll offer something called a break-even occupancy, and that means how occupied does the property need to be in order for us to break even or not lose money on it. And you'll want to see that in the 50s or 60%, because a multifamily property, it can't handle going below 50% occupancy. Otherwise, you will be in the red, and that will be a problem. So a good break-even occupancy is between 50 to 60%. Then typically there will be a property overview. So it'll talk about the grounds, and it'll talk about all the amenities and what kind of units there are. Are they 1-bedroom units, or are they 2-bedroom, or is it a 3-bedroom? Are they a bunch of 3-bedroom units? And typically there's a mix of units in the apartments. And finally, it goes into pretty deep into a financial analysis. So for you super finance minded people out there, you'll get excited about this. For those who are not super finance minded, this might be a lot to take in. But don't worry, it's all there for your information, so you can understand and make sure that there's transparency in what's going on in the business, because it really is a business. It's not just an investment. This is a business that each property is run like a business. So one of those is the debt. So what kind of loan is on the property? What you'll want to see is a long-term loan, or the ability to turn it into a long-term loan, because sometimes the properties, they will do a short-term loan, interest only, in order to go in and execute the business plan. So if we need to renovate the units and then we can raise the rent, well, we're not going to have enough income to cover all the debt if we do principal and interest. So we'll get an interest only loan for like 2 or 3 years, which can then be converted easily into a long-term loan at year 3 or 4. So you'll want to see that there is that option. When it becomes risky is if there's only the interest only loan and there's not an option to turn it into long-term debt. That's when things become a little bit more risky, and you'll want to that's a red flag for me. What's the return on investment, the ROI? That's the financial analysis will dig deep into that. And typically we like to see our returns to be somewhere between 17 to 19% is what we're trying to achieve for our investors. And then the cash flow. So the cash flow is important to know how much cash flow that you are going to get as a passive investor coming out of this property. So typically, if there's a lot of work to do for the business plan in year 1, the cash flow is not going to be all that great, to be honest. It will probably be low cash flow. But then in year 2, 3, 4, 5, the cash flow really starts to strengthen and to get going. There's the projections. So every financial analysis includes projections about what we think is going to happen in year 2, 3, 4, 5, and when we think we'll be able to sell it at the end, and the amount of money we think the property will be worth. Keep in mind, these are only projections, right? They're not something that the team is offering as a promise to you as a passive investor. It is a projection. And so if they're projecting a 17% return, you can expect to probably make between 16 to 18% on that property, sometimes more, and sometimes a little bit less, but that's the nature of the projections. And then finally, they dive deep into rental and sales comps. So what type of rents are happening in the area around? Because if a team comes in and says, oh, we can raise the rent on this $200 a month easy. Well, you have to know, is that true? And they have to support that, right? It's only true if other properties around them are achieving that same rent. If the one property they're buying and they're going to increase by $200 a month is now going to be $200 more expensive than every other apartment complex in the area, it's going to be very hard to keep that one full. And then there's also sales comps. So what have other properties sold for to make sure that you're not overpaying for this property. So I'm going to go through a 10-minute checklist. As a passive investor, sometimes it can be overwhelming to look through all these investment summaries and try to understand them and try to understand what's a good deal, what's not a good deal. So here's a quick 10-minute checklist to help you just scan through to see if you want to dig deeper and understand. Because if you get on multiple email lists of multiple teams, you'll be getting lots of deals coming into your inbox. And so you want to have a way to be able to evaluate them pretty quick. So number one, what is the asset class? So remember, in multifamily, there are several different asset classes. There's 4 of them. So there's the class A, which is all the bells and the whistles, has all the amenities. It's fancy. It's usually newer property. That's the class A. Class B is a step below that. It still has really great amenities. It's a little bit more expensive than the lower ones, but it's more of a middle, I think, McDonald's manager type apartment complex. Step below that is your class C. That's your working class housing. So these are typically older buildings built in the 1970s, 80s, 90s that need some work. They typically all need to be renovated to get up to better standards. And then you have your class D, and D stands for the dump. That's in high crime areas, very old properties. Those ones are really risky. They can be great investments, but they are quite more risky than the class A, Bs, and Cs. Okay, number 2, how many units are there? So this is important as a passive investor because if there's 100 plus units, typically it's easier to put property management on site than if it's below 100 units. And the importance of an on-site property manager means that there's someone there who has eyes on the property at all times, who it keeps the crime rates down, it keeps the problems with tenants down, and they're just there, and that's their full-time job, is managing that property. And so it just makes the property run more efficiently and more effectively. And so as a passive investor, I'm always looking for something that's at least 100 plus units. Number 3, what's the equity multiple? Remember, this is my favorite number to focus on, because the equity multiple tells you if you invest $100,000 into a deal, how much is that $100,000 going to turn into over the life of the deal? So typically we like to see equity multiples in the 1.8 to 1.9 range. And that's the equity multiple that you want to look at. So that means if you invest $100,000, when all is said and done, it's sold, you've gotten your cash flow over the 5 years, you would have turned that $100,000 into $180,000 to $190,000. Okay, number 4, what's the internal rate of return? Now, the IRR is a fancy financial calculation that takes into account the time value of money, because we all know that money today is worth less than it will be in the future. And so that's the calculation it takes into account. And an IRR, we typically like to see between 16 to 17%. Number 5, what type of lending is it? We talked about this earlier. Want to make sure it's not just interest only for 3 years and then there's no way to put long-term debt on it. And you want to make sure that there's an option for long-term debt so that we're not stuck in having a problem at year 3 when all of a sudden, oh, we can't get new financing on this. So now we have to sell at a loss. Number 6, how long is the interest rate fixed? Goes right along with number 5. Number 7, what is the reversion cap rate? Reversion cap rate, that's big words. A cap rate is the rate at which the property is valued. So, in California, for example, houses there are very much more expensive than they are in Texas. Well, it's the same with apartment buildings. So apartment buildings in California are going to be very much more expensive than apartments in Texas. So there is a cap rate kind of assigned to each area to determine what the value of the buildings are. So a reversion cap rate just says, okay, you bought the building today. What's the cap rate? So say the cap rate is 6%. And with that, and when you go to sell it at the end of 5 years, what cap rate do you think you're going to sell it at? And typically we want to see a reversion cap rate that goes higher by 0.5. So if you buy it at 6%, we want to see it saying, well, to be conservative, we're going to sell it at 6.5%. Now, when 5 years comes, maybe they can sell it for, at 6% or even lower. And there's an inverse relationship. So the lower the cap rate, the higher the value of the building. Okay, number 8, are there multiple comps that are higher, right? You go in and you check and say, well, are there multiple comps that are higher than this? Because if the property they're showing is the highest comps in the area, that's not good. That's not good news. Number 9, what's the projected rent growth? So you want to see on their investment summary that there is a lot of rent growth that's expected to happen. And number 10, what's the projected vacancy? Some areas, vacancy is only 3%. Other areas, it's 13%. And so you want to see what is the vacancy rate, because that will directly affect how much money the building can make. So that's the end. Like I said, it's just short and sweet. I'm going to do these every other week from here on out, and just to help you get some more information. So if you want to learn more, please go to my website, CamillaJeffs.com, and you can grab some other information there.